Let's start with today's tutorial. All right. I think some of you are actually coming from tomorrow's class instead, so that's good. So let's start with the first question here. 1A, state some of the benefit of transacting in stock index future over stock market transaction. So why trading in index futures will be better? Why index futures will be better than trading a single stock futures? Okay, or a stock market transaction. So very simple. When you talk about stock index, all right, there are several basically several advantages. So stock index future versus stock market, not SIF yet, and not SSF. So stock index means is index. Index if we're talking about Nikkei, Hang Seng, KLSE, all these are indexes. All right. Stock market means individual company stocks. All right. Why trading in SIF will be better than stock market? There are a few advantages here. Number one, lower transaction costs. Okay, lower transaction cost. Number two, diversification benefit. Index means it's already diversified. All right. Number three, there's an inbuilt leverage. And finally, number four, exposure to all markets. Okay, simple. All right. So indexes is basically a package, basically a combination of all the stocks in a particular market. So definitely it has exposure to all the market, diversification, inbuilt leverage, and over lower transaction costs. So these are the benefits of transacting in stock index futures. This is basically very theoretical here. Let's look at B here. So all this one A, B, C, A, B, A, B, D, E is basically all the theory questions. Okay. So B here, what is systematic risk and unsystematic risk? This one is very easy lah. All right. No rocket science here. Systematic versus unsystematic risk. So this one shouldn't be any rocket science to you guys anymore, since you guys are already third year students, at least second year. So when we talk about systematic risk here, it's non-diversifiable risk. Okay, you cannot diversify. All right, also known as market risk. Unsystematic risk, all right, is basically called as company or firm specific risk. This one is diversifiable. With what? With portfolio of stocks. So you hold different stocks, then you will diversify the risk. So this is systematic versus unsystematic. So B2, what risk do you face when you buy a single stock? Very simple. Okay, when you buy one particular single stock, you will get systematic plus unsystematic risk because there's no diversification going on. Yes, systematic risk, which is market risk, everyone will face. But unsystematic risk is only for those people who did not diversify. So if you buy only one single stock, you get these both risks, which is called total risk. Okay. B3. What risk do you face when you hold a well-diversified portfolio of stocks? So if you've got well-diversified portfolio of stocks, the only risk that you are facing is systematic risk. So this one eliminated because it's diversifiable with a portfolio of stocks. So if you have multiple stocks, then you don't have unsystematic risk, only got market risk or systematic risk. Fairly simple. Okay, so risk aside. Now we go to question C. Question C here, they're telling you if spot at time 0, it's 1010. Okay, risk-free rate is 6%, and annual dividend yield is 1.75%. What is the correct price of an SIF contract expiring in 3 months and 6 months? Okay, so what is the formula for this? F equals to spot times 1 plus risk-free minus dividend yield power of T. This is the formula. Okay, this is the formula. So, number 1. When we talk about 3 months, okay, so we're going to find F at 3 months. Spot is 1010. 1 plus risk-free rate is 0.06 minus your dividend rate is 0.0175. Power of 3 over 12. What is your answer? Okay, you'll be getting 1020.56. So question number 2, they want you to find what if is 6 months. Same thing, 1010, 1 plus 0.06 minus 0.0175, but it's for 6 months. So you get 1031.24. So this is to count the futures price. Okay, the futures price of your stock index. All right, basically you will try to calculate the futures price and compare with the quoted price to see is there mispricing or not. If there's mispricing, then there's arbitrage again. Okay, now moving to D. D, yeah. What impact would an increase in interest rate have on SIF prices and why? So if there's increase of interest rate, okay, D, yeah. What happened if there's increase on RF? Okay, how does it impact the SIF prices? All right, so very simple. When interest rate goes up, what happened? Interest rate goes up, it will lead to carrying cost goes up. Okay, carrying cost goes up, will cost your SIF price goes up. Interest goes up, your cost goes up. Cost goes up, your stock index futures will goes up. It's a cycle. Okay, it is a cycle. All right. And last, why do SIF contract have an index multiplier? What role does the multiplier play? So, very good question here. Why is there a multiplier? And what is the index multiplier? So the index multiply, normally, if it's not given to you, it's multiplied by 50. Okay. What role does the multiplier play? So this multiplier is for what? Why do we need to multiply the index? Why do we want to make it bigger? All right. So the reason is simple. Making it large for institutional players. So for corporate and organization, they want it large to see the profit or to see the price changes impact on their investments. So they're making it large by multiplying it so the industrial player or corporate players will be more attracted to it. So this is the only reason why they want to have an index multiplier, to make it large. For who? Institutional players. Easy. Okay. So this is basically the theory question regarding stock index futures. Any questions so far before we move on to the calculation section? Come on. Any question? Anybody? So far, all good. All right. Thank you, Joanna, for responding. Okay, that's very comforting to hear. So let's move on then. Question number 2 here. So, as a fund manager, you hold a portfolio with a beta of 1.6. Worried about potentially huge volatility over the short term, you wish to alter the beta of your portfolio to 1. Suppose the current value of your portfolio is 3.2 million and the futures currently stand at 1,000 points. Outline how could you use SIF contract for the purpose to adjust the beta to 1. So what is beta? Beta is risk. Okay, so in this question, the beta initially given to you is 1.6. So you want to change this risk appetite of 1.6 to 1.0. Your portfolio size is 3.2 million. And currently, the futures index point is 1,000 point. Okay, so you want to see how do you want to convert your beta of 1.6 to 1.0. All right, it's very simple. So the formula here is basically finding number of contract to hedge. Number of contract, it's equals to the changes of beta multiplied by your portfolio size divided by index. Of course, in your textbook, they got a more appropriate way of writing this formula. But in layman term, this is what it means. So you're going to see what is the number of contract here. Okay, it's in your lecture also. Huh? So your beta here, you are converting it from 1.6. So this is how you do. 1.6 minus 1. The changes is 0.6. So your portfolio size is 3.2 million. Index is 1,000. Multiply by 50. Remember the multiplier. So in the end, you get 0.6 multiplied by 3.2 million divided by 50,000. So in the end, you are getting 38.4 contract. So when it's 38.4 contract, you can't hedge by buying 0.04 contract. Okay, so rounding up to the closest number. So it's 38 contract. All right, so it's 38 contract. So when you see 38 contract, are you supposed to short or long when you want to hedge this? So you're holding this portfolio, you want to reduce your risk. All right, when you're holding something, you want to reduce the risk, you want to sell it off. So in this case, you short, you want to lock at the selling price. So the answer is short 38. Oops. Short 38 SIF contract. Because you want to reduce your risk from 1.6 to 1. You want to hold less. So you lock yourself to sell off 38 SIF contract. That is the explanation for this question. Understood? Can follow, cannot follow? No response. Chat also no question. So okay, I assume everyone okay, huh? All right. Okay, thank you. Thank you for responding. So now I move on to question 3 then. So question 3, you work at the arbitrage desk of MC Asset Management, a fund management company. Aside from managing stock portfolios, MCAM also does proprietary trading, largely index arbitrage. You now notice the following quotation on your screen. All right. The FBM KLCI index. So the spot price now it's 750 points. 3 months SIF, it's 746.64. Risk-free rate is 4%. Dividend annualized, dividend yield is 1.75, 0.0175. Hey, proof that arbitrage is possible. So means you need to count the mispricing. F equals to spot 1 plus RF minus D power of T. So count, is there a mispricing or not? F is equals to 750 multiplied by 1 plus 0.04 minus 0.0175 for 3 months. So 3 out of 12. The F that you get here is 754.13. This one versus with the given one, 746.64. So this is overpriced. Okay, so futures is overpriced. No, wrong. My mistake. 754 is the actual price. 746 is the futures price. So futures price is underpriced. Sorry, so future underpriced. So when underpriced, what do? You buy. When something is cheap, you buy. Okay, this is the calculation. You'll find out this is the true figure, but the quoted market figure, the market value is 746. So 746 is so much lower, so it's underpriced. Definitely buy futures. All right, outline an appropriate strategy, B. So the appropriate strategy here is buy futures. And then when you buy future, you need to have another opposite transaction. Short, spot. This is your strategy. Okay. Then C. Determine the profit assuming KLCI is at 775 points in 90 days later. So 90 days later, spot, it's equals to 775. What is your profit? Okay, just like what we did in the previous week, do the T diagram. Okay, do the key diagram, the T diagram. Cash market, future market. The strategy just now, long future, short spot. So how much spot price? Spot price is 750 multiplied by how much? 750 multiplied by $50. Okay, why is this $50? It's your index multiplier. 37,500. Now you receive this money. Long future, okay, your long future, one SIF contract is 50 multiplier. So again, the future price is 746.64 multiplied by 50. So this one, you buy 37,332. You spend money. So 90 days later, 90 days later, the price is 775 now. So you short here, you long here. Okay, you long spots 775 multiplied by 50. You buy back at 38,750. Okay, so you long future here, you short future. 775 multiplied by 50, you get 38,750. So in the cash market, you make a loss. Okay, you make a loss here. You buy 38,750. You only gain 37,500. So you make a loss of 1,250. In the future, you make a gain. You sell 38,750. You minus your cost of 37,332. You make a gain here of 1,418. Okay, remember what I tell you. You short spot, you get money, right? When you get money, you earn interest. So interest gain is equals to 37,500 multiplied by your risk-free rate, 0.04 multiplied by 3/12, because it's 3 months. So here you get 375. Okay, but because you are selling off the futures, you short spot. So when you sell to people, all right, people buy the stock from you, they will take the dividend from you. So dividend expense is on you. All right, dividend expense is on you. 37,500 multiplied by 0.0175 times 3/12. Okay, multiply by 1 plus 0.04 times 3/12. Why need to count this? Okay, you are paying the expenses to people, and then you are paying off the interest charges also for 3 months. The 3 months interest charge is 4%. The dividend is 0.0175. Okay, for 3 months, how much the value, and then it's being compounded interest. So in the end, the dividend expense that you are paying in total, it's 165.70 cents. Okay, so now count your net profit. Your net profit is 1418 minus 1250 plus 375 minus 165.7. So your net profit is 377.30 for each contract. Okay, 377.30 for each contract. Can see, cannot see. Up until here, can follow, cannot follow. Okay, All right, very good. So up to here can follow, very good. Then look at D. To what extent is arbitrage profit dependent on the FPM KLCI's performance? So to what extent? All right. So means they're asking you, your profit is based on what? So no need to ask. Basically, arbitrage means the profit will be depending only on the mispricing. Okay, it's only depending on the mispricing. So in this case here, you want to prove that it's really depending on mispricing. You do another T diagram to prove it. Just do, oops. Just do another T diagram to prove it. Okay, cash market, future market. So over here, no need to do much lah. You just repeat it. Short at 750. So here, 750 multiplied by 50 is gaining 37,500. Future market, you long at 746.64. 746.64 multiplied by 50, you bought at 37,332. So 90 days later, you assume, all right, the price got no changes, it's still 750. So you buy back long at 750. So 750 multiplied by 50, you buy back at 37,500. Okay, any gain or loss? None, equals to 0. Any interest gain? You got the money, same like just now, multiply by 0.04 times 3 over 12. So your interest gain here is 375. Dividend expense is the same like previously. 37,500 multiplied by 0.04 times 3 over 12 plus no, this one is 1 plus 0.04. Dividend first, 0.0175 times 3 over 12 plus 1 plus 0.04 times 3 over 12. Okay, so dividend expense is exactly the same, 165.7. Let's see, you long 746, you short at 750. 750 multiplied by 50 is 3750. So any gain here? 37500 minus 37332, you get 168 gain here. So add up, see what is your gain. So see your profit here. Profit 0 plus 168 plus 375 minus 165.7. So you get the same answer, 377.30. Can you see that? Although the price 90 days later is different, but yeah, net profit is the same. This already proven that your profitability is at the extent of the mispricing. So if the number of contract you are spending is 1, then your profit is only fixed that way. The arbitrage is fixed this value. Okay, the only way to increase your profit is to have more units. That's all. Other than that, the price will be the same, regardless of the movement. So this is the wonder of arbitrage. I think by now you guys should be very, very familiar with this. All right. Can follow, cannot follow. Okay. Very well done. All right. Ichi-san say can follow. Good. So let's try on question 4. See what question 4 tells us on part A. So question 4A, you are currently long on a stock portfolio. What has a beta of 1.6? Given recent uncertainty, you intend to reduce the beta to 1.2. Your portfolio is currently worth 2.8 million and the KLCI futures is 800 points. Show how the objective can be achieved using a standard stock index futures contract. Okay, how do you want to hedge this? All right, so look at A. We're talking about hedging. A. So let me erase this off. So when you see 4A, they want you to hedge 4A. So they tell you the beta is 1.6. 1.6. But they want to change this beta of 1.6 to 1.2. All right. You are having a portfolio of 2.8 million. Sorry. Your portfolio is now currently at 2.8 million. All right. The futures is 800 points. Show how to achieve this objective. So very simple. Just do according to the formula just now. Number of contract, it's equals to changes on beta multiplied by portfolio value divided by index. So your beta changes is basically 1.6 minus 1.2, 0.4. Portfolio value is 2.8 million divided by your index of 800 multiplied by 5, by 50. So this will give you 28 contract. And then this 28 contract, you want to reduce the beta. You have the portfolio. So when you have a portfolio, you're holding something in hand, you get the price devalue, what do? You short. So the answer for 4A is you short 28 contract. Next, 4B. 4B, given the following codes, the FBM KLCI index at spot price now is 747 points. Risk-free rate, it's 0.045. The dividend yield, it's 1.75. All right. So what should you do with this given information? Okay. So when they give you this kind of information, very simple. They want you to see, is there any mispricing or not? All right. So use the formula of F equals to S plus 1 plus RF minus D power of T. Seven four seven 1 plus 0.045 minus 0.0175 power of, this is for how many months? 3 months. (90 days). Okay, you look at B1. B1. If the 90 days FMBM KLCI futures contract, it's 762. Show that arbitrage is possible. So find out what is this first, then compare with 762. So from here, you manage to get is 752.08 versus the quoted price of 762. Okay, so quoted price here, it's overpriced. This is actual price. Quoted price is overpriced. So when it's overpriced, you sell. Okay, you sell. So they ask you to outline the strategy. All right. So they ask you to outline the strategy. Never ask you to count the equation, or need to what do you call that? Count the profits. So see, they ask you, it's actually B2 lah. This is B1. This is B2. Okay, B2 means outline the arbitrage strategy. What can you do? You know it's overpriced. You sell what? So short future, long spot. All right, short future, long spot. So no money to buy spots, borrow money from financial institution. Okay, so basically here is sell 762, buy at 747. All right, sell 762, buy at 747. And that's basically a simple one. It's similar to the previous question, but just that this one, they never ask you to calculate the profit. You just do until here, according to the question. Unless they call you to show the profit from this arbitrage, then you do further. All right, I think no rocket science. This is actually combination of the two questions that we already covered initially. Okay, so now I'll cover question 5. Question 5 a bit different. Okay, question 5 a bit different. Suppose that you are a portfolio manager. Your portfolio consists of 150 million of stocks. So portfolio, $150 million with a beta of 0.9. And 10 million invested in treasury bills. Okay, the spot S&P 500 index is 1297. Spot price 1297. While the S&P 500 futures is priced at 1300. Future 1300. What is the overall beta of your portfolio? A, yeah. What is your overall beta of your portfolio? Beta of your portfolio is equal the sum of weightage multiplied by beta of your investment. The weightage of investment times your beta of investment. So how do you count this? It's similar to how you calculate your WACC. Who just came in and did not mute? Yeah. So your beta of your portfolio is similar to how you count your WACC. So in this case here, all right, you consist of 150 million of stocks in a in a common stocks with a beta of 0.9. So your portfolio size, your weightage of your portfolio size is 160 million. Why? Because 150 mil, it's in stocks. The other 10 mil is on safe indexes, which is treasury bill. So 150 divide 160, okay, multiply by the beta. The beta of your stocks is 0.9, the risk, plus 10 million out of 160 million, multiply by this, what we call that, 0. Because you're talking about treasury bill. Treasury bill is government bill. Government bill is basically riskless, no risk. So that's why it's 0 there. Combine these both, you can count the beta of your portfolio. Okay, which is 0.844. Okay, so the overall beta of your portfolio consists of $150 million on stacks, 10 million on safe stocks, which is treasury bond. So in the end, both of you add up, you get the portfolio of 0.844. Then now, 5B. You believe that the probability of stock market decline has increased and therefore risk to reduce the beta of your portfolio to 0.6. Outline the right strategy. The index multiplier is 100. So no more 50, index multiplier now is 100. They tell you 100 there. Okay. So you want to count, how do you want to hedge this? So use the number of contract formula again. To hedge this is a difference of beta multiplied by portfolio divided by index. Okay, so the beta that you have initially, you calculated here, this is the beta you use. The initial beta you have is 0.844. Now you want to reduce it to 0.6 further some more. Okay, you have 160 million portfolio divided by index is 1300 multiplied by 50. So this will give you 300.3 or equals to 300 contract. So you long or short, you own all these stocks. So in the lower down your risk, you short lah. So you still short 300 contract, 300 SIF contract. Oh yes, sorry. You're right. This question, they set out the multiplier as 100. Thank you, Jisan. My mistake. Thank you. So the multiplier is 100 for this question because it's mentioned there. The index multiplex is 100. All right, if it's not mentioned, it's 50. Okay, then part C. Suppose instead that you wish to reduce the beta of your portfolio to 0, how many futures contract should you use? What should the expected return on this portfolio approximate and why? All right, so now you want to reduce the beta to 0. Okay, you don't want to stay, you don't want to have any risk at all. You want to minimize straight away. So in that case, your C, straight away take 0.844 minus 0. So you need to diversify 0.844 beta. $160 million divided by 1003 times 100. So you get around 1038.77. All right, 1038.77. Okay, again, you want to short it to the closest number. Okay, so by right lah, you can short 1039 contract. You can short 1039 SIF contract. That's part one. What should the expected return on this portfolio approximate? So what is the return for this? So just now, stocks, the beta is 0.9. Okay. Risk-free treasury bonds. Risk-free treasury bonds. The beta is equals to 0. So the when you reduce the risk by shorting 1039 contract, you reduce your risk from 0.844 to 0, which is the treasury bill returns. So your gain or your return will be similar to the risk-free return. All right, this risk-free return here would be your return. They never give you the figure of this risk-free. So this risk-free is equivalent to your return when you minimize your data, your beta to 0. So you converted all your risk into neutralize. You neutralize everything into risk-free investment. So the risk-free investment will guarantee you a certain percentage. So this percentage is not given to you lah. So you just need to know that the risk-free return is equivalent to your return when you hedge it to 0. Cannot. All right. Okay. So let's try another arbitrage question, which is on question 6 here. You are trying to convince a client about a riskless arbitrage opportunity. The following quotations are available today. 3 months future. 3 months future, 608 points. KLCI spots, it's at 600 points. Maturity, 3 months. 3 months K LIBOR. %4. Dividend yield, 0.02%. How would you prove to your client that your arbitrage is possible? A, count the exact futures price. F is equals to 600 times with 1 plus 0.04 minus 0.02, 3 out of 12. So this will give you 602.98. 602.98 versus 608. All right, 602.98 versus not 608 lah, your futures price, which one? 608. Okay, compared to 608. So actual price 602, but the futures price is 608. So 608 is higher. So when it's higher, it means overpriced. When overpriced, what do? You sell. So you short future. Okay, you short future. You short. So short future at 608, long spot at 600. This is the strategy. B, show the profit attainable if the index is 603 point at maturity. So 90 days later, the price is 603. Let's count. Cash market, future market. Long spot, long at 600. 600 times 50, you get spending money of $30,000. In future market, short one SIF contract at 608. 608 multiplied by 50, 30,400. $90 days later. $90 days later, you long already, you short back. Always the opposite. So they tell you to assume the price is 603, short at 603. 603 multiplied by 50. You buy 600, sell 603, definitely earn 30,150. So the gain 30,150 minus 30,000. So your gain is 150. Interest expense. Because you buy, right? So you buy, you borrow the money. Okay, so you borrow money means 30,000 multiplied by the interest rate. Interest rate, how much is the interest rate? Let's see. 3 months key LIBOR interest rate is 4%. 0.04 multiplied by 3/12. So your interest expense here is $300. Lastly, because you buy, so you get dividend. Dividend received. 30,000 times 0.02 times 3/12 times with 0.1 plus 0.04 times 3/12. So the amount of dividend that you receive is 151.50. What about the future here? You short at 608, then you long at 603. So 603 times 50 is 30,150. Okay, so in the future market, you make a gain also. 30,150. No, initially it's 30,400 minus 30,150. So the gain is also 250. Not also like it's 250. So let's count the net profit now. The net profit here, gain 150, gain 250, loss 300, loss 151.5. 150 plus 250, 500, 500 minus 300 is 200. This one is dividend received. 200 plus, no. 150 plus 250 minus 300. Okay. 300 plus 151.5. Okay. So your net profit here is 251.50. 250 plus 150, 400, 400 plus 151 is 551 minus 300. So it's 251.5 of profit margin. Okay. Next, last one here. How much you convince your client that the profit derived in B is indeed riskless? So you can do a similar thing here. I'm going to show you. It's just like just now the question. Okay. So imagine you change the figure to 600. Everything remained the same, but this one changed to 600. This one also at 600. So the only changes will change here is 30,000 shorts, buy at 30,000. So there's no more gain. Okay, there's no more gain there. All right, here you short 608, you long at 600. So means you buy back at 30,000. So 30,400 minus 30,000, your gain in future got extra. It's extra 400 now. All right. So let's see this new profit margin when it's at 600, is it the same or not? So the profit is negative 300. So it's 400 gain plus 151.5 minus 300 minus 0. It's the same thing. What? 551 minus 300 is 2251.5. So if the question ever asks you to prove, all right, to prove, okay, or to convince your client that this is riskless, means irregardless of the movement, go up, go down, whatsoever, your profit is still fixed at 251.5. That's the only thing you want to tell them. You want to tell them that the mispricing is the one that earning you money, nothing to do with the what I call it, other factors. So basically over here, everything remains the same. Only problem here is because of there's mispricing. So this mispricing will guarantee you each contract you earn 251.5. That's all. Again, you can repeat it with 605, 610, 700. Regardless of how big you change the number, you still get 251.5. This is arbitrage, and you guys are aware about this. Okay, previous tutorial, all we talk about this very often. All right. So I think this shouldn't be a problem. Okay. Now we want to go into stocks. Okay. SSF. What is SSF? SSF stands for single stock futures. So number 7 here, a stock is currently selling for $16. So the spot price of the stock is currently selling at $16. The stock normally pays a dividend of $2. Dividend is $2. So what is the dividend yield? $2 out of $16. This is the dividend yield. Okay, so let's see, $2 out of $16. 2 divided by 16, 0.125. So the dividend is 12.5%. Okay. In March of each year. So every time in March of each year, they come out dividend $2. It is now end of February. So it's February end. The risk-free is 6%. Risk-free is 6%, 0.06. What should the correct price for the SSF contract on the stock with a 1 month maturity? So you're talking about a time 1/12. So now it's already end of February. March, they give you dividend. So your price is already taken into consideration of your dividend. Okay. So what is your future price in 1 month time? So the proper formula is F equals to spot. Same thing lah, same formula. 1 plus risk-free minus dividend yield power of T. So now you set T is 1. So F1 equals to your spot price of $16. 1 plus 0.06 minus the dividend yield, which is 0.125, power of 1/12. So your futures price is supposed to be $15.91. This is to count SSF. No changes. It's still the same thing. SIF, SSF to count the future value is the same technique. Okay. So now we come to discuss on SSF also under question 8. So question 8 tell you describe how SSF contract could be used in each of the following situation. So this one we will just discuss it verbally. So A, an investor currently holding AirAsia stocks and believe in the long-term potential. Okay, a person who invested in AirAsia, they believe that is for long-term purposes. But this investor is worried about the expected oil price hike on the stock performance over the next 6 months. So they're scared that the oil price which go up will affect the AirAsia stock that he is holding in the next 6 months. In other words, he's worried that AirAsia stocks will drop because of oil price goes up for the next 6 months. So how can he use SSF contract to hedge this situation? So what he could do is he already got AirAsia stocks. So he could be hedging it by shorting AirAsia SSF at 6 months maturity. Because you know that this oil price will cause your performance to change in the next 6 months, right? So you cause in these next 6 months, the price drop until badly. So the best way for you to do, you lock yourself to sell at a particular price for the next 6 months. So if the price drop until something that is so bad, you can still sell it in the future and make that differences on earning. Then you can reduce your losses. So the answer for the first one is hedge by shorting AirAsia SSF for 6 months maturity. Next, part B. A fund manager with a large exposure to gaming stocks. So this fund manager, he buy a lot of all these gambling stocks, all these gambling company stocks lah. Believe that impending changes to the entertainment tax, okay, that means the changes into the entertainment tax will benefit Berjaya Toto but hurt Genting. So Berjaya Toto, it's a gaming stocks. Genting also is a gaming stocks. So he believed that the new tax will be beneficial to Berjaya but bad to Genting. So in this case, very simple. What you know that Berjaya gonna shoot up, then you buy Berjaya stocks lah. Okay, you buy Berjaya SSF. At the same time, you think that Genting stocks will drop, and then you have a last exposure. That means you have this stock also, so you can short Genting SSF. In case Genting really drop badly, you can still sell at the price you are happy. All right, very easy. C. A speculator believes palm oil price have peaked. That means this speculator already predicted that palm oil price already reached the highest point and likely to experience a steep correction. That means steep correction means going to drop back. So it already reached the maximum. When things go maximum, it will drop back. So in this case, how can this person hedge? So he can short a palm oil company. So in this case here, he can short Sime Darby, he can short IOI Corporation. So anything to do with palm oil, any company to do with palm oil, their price will drop when the price of palm oil drop also. So what he can do is he can short these palm oil companies. Lastly, a portfolio manager with a large position in SCOMI Berhad. The stock currently is at $6.50. Okay, this portfolio manager want to cut off half of his position if the stock reaches 680. Okay, so he's holding SCOMI stocks. All right, and the SCOMI stocks currently at 650. So he want to cut off half of his stock when it reach 680. So what can he do? Short SCOMI Berhad SSF, half of his holding lah, at 680. Just fix it only one. So if let's say he got 100 SCOMI stocks, so what he could do is short 50 SCOMI SSF at $6.80. So once it hit $6.80, okay, he can already manage to clear off half of his stocks. Simple as that. All right, so you just need to short 50 SCOMI at 680. No need to think, no need to wait for the stocks also. So you just set to sell the price at 680. All right, and this is the last question for today. So, yep, so far, any questions? Guys, any questions or not? Can follow, cannot follow? No questions. Can follow. Good for now. So next week, we are done with options. No more options ready. So next week, sorry, no more futures ready. So next week, we'll go into options. Okay, you go to options. All right, so I will tell you what is the options about. Next week is only introduction to options. Then after that, we'll talk about the strategies of options. Okay, so make sure you now already completed your futures. You already did your test also. So masters your futures. And the next step, we're going to the second half of the semester now already. We'll go into options. All right. So, yep, I guess that's all for today. I will share with you your attendance code. Then I'll see you guys next week. So for those of you who came in for replacement class today, don't worry about your attendance. Because tomorrow is a public holiday, your attendance will be automatically marked. So you will not be affected. Okay? The reason for you to come for the replacement is so that you know what's going on without waiting for the video to be uploaded and only watch later on. So this is the code for today. So those who already enter your code and have no questions, I'll see you next week. And please take good care about yourself. You're most welcome. Take care. See you guys next week. Welcome. See you guys next week.